Stephen Nathan joins us now, the founder of 10X, and before that, one of the top-rated analysts in South Africa. Stephen, it's always good to be talking with you on days of big announcements. And the big announcement today is the unemployment rate has gone up by 1.8 percentage points to 34.4%. Now, put differently, we were at 32.6% before this, for the first quarter of the year. So it just seems as though things are going from already really bad to even worse. And you have to scratch your head and think, well, if it must get to a rock bottom at some point in time, that someone will realize that the number one priority in South Africa is jobs.
Yeah, it's terrible. I mean, it's almost incomprehensible that we can still increase our unemployment rate, given that we probably have the highest unemployment rate. Certainly would be in the top 5 or 10% globally of even destitute countries. I mean, it's as I say, it's almost incomprehensible for us to understand what does it mean that 35%, almost 35% of people are unemployed. And then, as you know, there's a broader definition where people are just disillusioned, so they've given up looking for a job. And when you look at the broader definition, that's over 40%. So this is a crisis, and this is a crisis that that unless it is addressed, we're going to risk the economy, the social stability, the very fabric of South Africa. And this is the one statistic that government should focus on as a top 3 priority, and they should have a plan to reduce unemployment. And unfortunately, if you look at South Africa, where employment has been created, it's really been in the government and in the parastatal sector. So, if we look at what's happened, obviously with COVID, a lot of private sector jobs have been lost. But what we're not seeing is government's not cutting at all. So if you looked at it from a private sector perspective, if you had to strip out how many people government employ, I'd hate to see what this number would do, but it would go much higher than 34% if you look at the private sector, because the government quite simply is crowding out the private sector. And if you look at the budget, I always find these sort of big numbers quite interesting, because often we get lost sort of in the details and some of the ratios. But just to give you a sense, is that last year, so in the tax year ending 2021, government expenses were 42% of GDP. Now, obviously, we can say, yes, that's a bit of an anomaly because there was COVID, so maybe some GDP was depressed and government spending was slightly elevated. But if you look at 2022, government is expecting that to fall to 38%. So it means that government is spending 38 cents in the rand of the total economic output of South Africa. Now, that's crazy, because if we look at how inefficient government is, and governments don't create wealth, they don't create jobs. They should create an enabling environment for the private sector to do well and to create jobs. So government really needs to do something, because this is why we have a negative outlook on our credit ratings, and why a lot of people are concerned about the long-term viability of South Africa.
There was an excellent piece in Politics Web this morning by R.W. Johnson, who is a former Oxford Don and a wonderful commentator who tells it like it is and has been doing so for a long time. But he took the Piketty numbers, which have been produced, or Thomas Piketty, who wrote Capital, and then has done numbers on Gini coefficients, or basically the highest inequalities in the world. And he explains that in South Africa, the inequality is now at an all-time high, much higher than it was in 1994, and that the process, which really supports what you were saying a moment ago, of the ANC government has been to actually protect and to pay more to public servants, who are a fraction of the total population. So it's almost like you've got a bit of a monopolistic situation. You got a job and you work for the government, you're all right, Jack. But the rest of the economy is really, really struggling, and hence we see it in the unemployment figures. You have to wonder whether this message is getting through, given that only in the past week we had yet another proposal from the Social Development Minister that you add further taxes to an already overtaxed population and use that to pay people who don't have jobs, and they don't have jobs because the economic policies are wrong. It's almost like, when are we going to start looking at the cause rather than the symptoms?
It's very difficult to understand, what government is basing its policies on. There's obviously a lot of emotion in terms of what it's basing its policies on, but the facts and the evidence just aren't there, because the track record of wealth creation, or real incomes, and unfortunately, as you say, the Gini coefficient sort of means that the rich are getting richer and the poor are getting poorer, and that's exacerbated in South Africa. So we have created very wealthy people of all colors in South Africa, but that doesn't matter, because we're not uplifting the population as a whole. And the government, as I said, it's almost like Einstein has said, the definition of insanity is doing the same thing and expecting a different result. And the evidence is overwhelming that a government that wants to centralize and command and control, and we can call it communism, we can call it extreme socialism, that has failed unequivocally. And the results show that the government is not winning the war on poverty, they're not winning the war on employment, and they're not winning the war on opportunities, on creating opportunities for the vast majority of South Africans. So they're failing South Africans, yet they seem to be operating in this bubble, ignoring the facts and ignoring reality. And as you say, rather than looking at why are our policies not working, they seem to be more confident to go down that path. And as you say, this thing about compulsory pension funds, that's not new. This goes back to at least 2002, and even in 2007, 2008, there was a big, very similar paper which more or less said the same kind of thing. And the concern is that, yes, we know that there are a lot of poor people in South Africa, and that people's pension funds are underfunded, and not everybody is covered, has adequate risk benefits. So, when they have a risk event like a death or a disability, they are underinsured. But that's the outcome of a very poor economic growth environment and incredibly high unemployment, which is due to bad policies. We're not going to fix it that way.
You must think that perhaps in a way you can celebrate this, because it just shows more idiocy on the economic policies, which eventually would lead the voters to make different options. We saw what happened in Zambia, and I know I hark back to that, but that is an African country where you had an equivalent of the ANC who were booted out of power. Maybe those pennies will start to drop, but until that time, you have to wonder whether this idea of Pretoria, of doubling down on dumb decisions, is not somebody somewhere is going to say, hang on, guys, we've already been losing quite a lot of our seats in parliament and in the municipal elections. If we carry on along this road, we are going to be losing more, and we aren't going to be able to employ these ideas of ours, and maybe just become a bit more pragmatic and sensible.
Yes, well, Eric, there's a couple of things there. So who is the alternative party? And as you say, hopefully the voters who put politicians in power and who determine the government of the day, hopefully they feel that their interests aren't being looked after. And there's been a lot of debate around that. Is the ANC buying votes? Is this program of more and more of a social welfare state, where we have something like 18 million grants paid per month and growing? Is that a way that the government is trying to buy votes and sort of placate the voters, or will the voters see through that it actually isn't in their best long-term interest? And one would need a strong party and strong leadership to get that message through. And hopefully that does happen, as you say, and hopefully we do follow the Kenya example, where bad governance and bad ruling for many years is not tolerated indefinitely. So we don't reward bad performance, and we don't reward underachievement at the expense of the country. But just on one positive note, and this is going back to the social development, what's interesting with the retirement fund reform is that there's really two government departments that are involved, and the other one is National Treasury. And really what happened last time around is National Treasury said, no, this is unaffordable, and it's going to negatively impact the tax base. And the one, at least that I can think of, certainly the one saving grace we have in South Africa is that National Treasury has really been very sensible and very prudent, and they have blocked, up until now, they have blocked these kind of proposals. So it's interesting to get their take on it, because as I say, there's nothing new in this paper. This paper was circulated more than 10 years ago, but there was a big difference in opinion between social development wanting this and National Treasury saying, well, we have to fund this and we don't know where we're going to fund this from.
Moving back in a more narrowly focused area, my colleague Justin Roberts pulled out all of the share buybacks that Naspers and Process have done since they started spending up to $5 billion on the whole idea of buying back your own shares, because you do that as a company when they're cheap. And they've lost 20 billion rand in the process. I guess it shows you that if you're an executive of a company, you don't really know what Mr. Market is going to do to your share price tomorrow. And it must bring a big question mark over share buybacks generally when you're talking about very, very well-paid executives who are now literally destroying tens of billions of rands in value.
Yes, it's always, I guess, in general with a company, it's always difficult or risky when the company themselves takes a view on the, as you say, because the company is emotionally attached to it. So in a way, they should know more because they are insiders, so they should have a better insight into the company without a doubt. But on the other hand, they are also too close to the action and maybe emotionally invested in that. So it's quite a difficult action to take. But if you look at Naspers,
but Stephen, sorry, they also can be financially invested because of their share options. It depends on,
without a doubt. No, without a doubt. Well, exactly. So there's there's conflicts of interest, and but I think for me, what it shows with Naspers is that Naspers has traded at an enormous discount for several years, and we've spoken about this, as have others, is that management's actions have not added shareholder value. In fact, they've done the opposite. They've continued to try and financially re-engineer listing with Process, trying to narrow the discount, trying to narrow it through an offshore listing, trying to narrow it through share buybacks, and it hasn't worked. And as you say, they've been incredibly handsomely rewarded, and they haven't added any value. And unfortunately, they've been paid very handsomely, and they're probably not going to suffer nearly as much as shareholders will suffer, who don't get these outrageous bonuses. So it is a very sad situation to see. And hopefully the board of Naspers will wake up and see, well, maybe this management team, hasn't done the right things consistently for shareholders, and maybe we need to have a serious reevaluation of the strategy of Naspers. I mean, I guess on a positive note, they have spun out MultiChoice, which is quite interesting because that's a 50 billion rand company. It's listed independently on the JSE. It's got a market capitalization of 50 billion rand, which is sizable. And then sitting in Naspers, it was accorded absolutely zero value. So that is an indication of how they can potentially add value.
The Naspers price is determined by what happens at Tencent. Tencent listed in Hong Kong, coming under fire from the Chinese authorities, today announced the share buyback, doing exactly what Naspers and Process have done. Hopefully they don't destroy as much value, but the omens aren't good given the way that the Beijing is going about attacking capitalists there.
No, you're exactly right. I mean, it's fascinating on a global scale to see the stance that the Chinese, and we call them the Communist Party, are certainly acting up to that their name as a Communist Party, and their policy of far more inclusive growth. I mean, it's quite incredible to see the heavy-handed manner that they are doing it, and it's very concerning because you've got these wonderful companies that have uplifted Chinese lives in many ways. I'm sure that there's a downside to technology and kids spending too long on the internet, and maybe profiteering in areas where the government hasn't been on top of its game, like education. But it's concerning because you would think there's a much better way to bring the private sector in line with what the government wants, especially in China, where the Communist Party is all powerful. So they are going to get their way. It would have been much nicer to see them to get that way in a far more cooperative environment, because as you say, now these tech companies are scrambling. I think Tencent just donated, was it 7 billion to some sort of
7.7, yeah.
7 billion, where they said, "Now we've always been thinking about this, we just haven't really gotten around to do it." But all of a sudden, we've done that now, and I think many others are following suit. So there's almost an embarrassment of riches. They've got a lot of money, they don't really know what to do with it. They don't want to keep investing because the returns on invested capital in Chinese tech are almost certainly going to be much lower than in the past. So you're sitting on a lot of cash. They're trying to buy back their own shares, which is also a very defensive strategy, and it doesn't send a positive signal to the market, especially when you're a fast-growing business like Tencent has been to date.
What are we missing here, Stephen? Because the rock star asset manager of Wall Street, Cathie Wood of ARK Funds, is now buying back into China. She got out of Chinese tech stocks a few months ago. Now she's buying back in. Tencent is buying back its own shares. And yet the feeling that I get from everything that I'm seeing what Beijing is doing is that they are going to be swimming against or sailing against a very, very strong wind, a very strong headwind. What are we missing, though? What is she seeing? What is Tencent's executives seeing that we perhaps aren't?
Well, I think it's very difficult for us, certainly sitting in South Africa and not living in China and not understanding the Communist Party and not being privy to their thinking. But from everything we can see, is that they are determined to reduce the profitability of these companies and to try and use their technology and their expertise for much more of a social good. So we've spoken about South Africa interfering sort of in the private sector, and this would be some element of that. So if I think it's different investors. If you Cathie Wood sitting in ARK as an investor, you might say, well, here's an opportunity. The stock is off, more than 50%, I think it is, since it's high. It still grew earnings this period. So it's still growing earnings. There still is an enormous market opportunity. Yes, there's uncertainty over some of its sort of monopolistic powers. But, there's still probably a lot of runway, long run for, Tencent. And maybe they're saying that, it's sort of more than in the price. And the government is not going to nationalize these companies, and they're not going to destroy these companies. So this might be a good time to invest. I think if you're management, it's a bit different because you're not an investor. You haven't got the whole globe to play with. You've only got your company. And that's why I think it's a very different message that management is sending, where they're saying the best option for us is just to buy back our shares and to almost shrink to glory, because that's what you do. When you buy back your shares, you make your company smaller by reducing the number of shares in issue. You're saying that's the best opportunity for us. And as I said a minute ago, I think it's because the alternatives, where else are you going to put your capital? Well, you don't know what returns you're going to get, and you don't know how much the government is going to eliminate those returns. So just invest it in your own business and try and shrink to glory.
Okay, so I'm going to throw something at you very wild, but I have been reading the Financial Times and Financial Times of London and the Wall Street Journal, where they've been putting a lot of emphasis on Taiwan. The Chinese strategy for the last 25 years has been to reabsorb Taiwan into the Chinese mainland. The Taiwanese are being protected by the Americans, but we know the Americans weren't great protection in Afghanistan, and so now the Chinese have been sending many more of their jet fighters over, kind of buzzing over Taiwan, showing them we mean business. What would happen from an investment point of view if China were to attack Taiwan and to take that step of bringing it back within the mainland fold? Just as I say, it is a curveball, but it is a potential risk. Certainly, when you read what's happening on the ground in what the international commentators are saying, what would the impact of that be in your crystal ball for Chinese stocks like Tencent and by definition Naspers?
So Alec, if we kind of look at what's happened, maybe where we are now, maybe the last 3 odd years, China with Hong Kong, I think would be quite an interesting sort of example for that, where China has asserted its dominance on Hong Kong. They certainly have interfered in the politics over there, and there was quite a strong uprising from Hong Kong residents, and also quite strong support from some international businesses supporting Hong Kong's sort of independence from China, and the Chinese government cracked down on that. And what we've seen is that the Chinese government have won. They've been able to materially reduce the freedom of speech in Hong Kong. And even we've seen some sizable businesses actually now side with the government of China rather than with Hong Kong, or with freedom of sort of speech. And that's a bad sign. But when it's the only way to protect your business interests, one can understand it from a commercial perspective, even if we can't understand it from a moral perspective. And if you look at the US and others' influence over Hong Kong has actually been very limited. And I would say Taiwan would be similar, as you've said. China wants to bring them back into the fold, put them back in their place, as they've done with Hong Kong. And I wouldn't bet against China succeeding. Obviously, it would be very negative from a sort of global perspective. Just the message it sends. Taiwan is enormous in the semiconductor manufacturing. There's a global shortage of semiconductors, and if China had to get involved in that, that could also create more challenges for supply chain and for kind of cybersecurity and geopolitical unrest. But I don't, I think China's pretty adamant, and I think that they've shown how they will react to these things, and I don't think they'll be too swayed by political or business pressure.
And the Americans at the moment don't seem keen to fight anymore, even for the staunchest of their allies, supposedly, in Taiwan. And there's some really interesting commentating that's going on around that now, almost to say that the Chinese have been watching what happened in Afghanistan, which I think they border that country anyway. So they're very close to what's happening there, and they're seeing this as a weak president in the White House, and perhaps one of their best possible opportunities to reabsorb Taiwan, which would have split out more than half a century ago.
Yeah, and also, China has the advantage. They have a couple of advantages that America and a lot of other democracies don't. Firstly, they're not a democracy, so they're not worried about getting voted out of power. No one's going to vote them out of power. Whereas if you look at the U.S. president, before they make a decision, they check the polls, and they probably look at the impact on the polls before making a decision. So in America, you're playing the short game, where you just want to get re-elected, the next for your next term, and China's playing the long game. And then, as you say, China can look for these opportune moments where they sense weakness and can really sort of benefit or attempt to benefit. And it's very hard for the West to react to that.
But the question is, what does that do to investments? What does that do to China-listed stocks if China went to war over Taiwan?
Well, it's not good. It's not good, and unfortunately, the problem with capital is that it's unemotional, and people will just look at the investment opportunity. So often, what happens with these sort of things is where these geopolitical instability, is initially the market might react quite negatively to that, but I think in and of itself, I wouldn't imagine that having a sort of a prolonged effect on global sort of equity markets. What it does signal is much more of a protectionist nature globally, and much less global cooperation. And that, when you start to build walls around your country and become insular, that isn't good. That isn't good for global trade. That isn't good for global prosperity. That's not good for collaboration and sharing ideas, and sort of uplifting everybody across the globe. So that if we get into that sort of scenario, then I think almost like a Cold War type scenario, obviously that would have somewhat of a depressing impact on stock markets.